The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very good morning and warm welcome to Squawk Box Europe. I'm Juliana Tattlebaum with Karen Cho and Steve Sedgwick. And these are your headlines this morning. The U.S. government remains in shutdown, but President Trump sees a silver lining, saying the administration will use it as an opportunity to save billions of dollars. Markets brush it off with the Stoxx 600 and S&P 500 closing at all-time highs.
European leaders back proposals for a drone wall to block Russian intrusions, warning of Moscow's increasing threat to the continent, but fall short of agreeing a plan to use frozen assets to help rebuild Ukraine.
And OpenAI unveiling its latest partnership with Samsung and SK Hynix in South Korea, sending shares in both companies soaring. While here in Europe, the CTO of Microsoft tells our very own Arjun OpenAI is the key to its future.
OpenAI is maybe the most important partner that Microsoft has ever had. And Microsoft is in this interesting position that we've had over its 50-year history, a bunch of important partners.
Well, we've got the government shutdown.
Good morning.
Good morning.
Good morning.
Good morning.
We got the government shutdown underway. Markets don't seem to care. We were talking yesterday about how much markets really worried about this government shutdown. I think we have our answer. All-time highs for equity markets here. I would argue that the more important piece of information we got yesterday was the ADP employment report. We're not going to get the NFP report this week. And ultimately, it was another signal that the Federal Reserve has ammunition, has more of a case to cut rates.
You know I love to disagree, so let's just get this underway. And to me, the market yesterday was driven by healthcare, and that healthcare bounce was really on the back of the tariff certainty, Pfizer having negotiations with the White House. So if you look at the weightings of sectors, materials down, healthcare was the best performer. And if you dig down into even some of the big tech names, you can see there was still some caution. I mean, FANG plus stocks over the trading day were down 0.5%. That's hardly a powerful rally taking place in FANG plus stocks. It was really that massive component being pharma stocks that have been somewhat left behind. I think we've seen the appetite in markets. It's taken us to record levels. And what we had yesterday was the market just powered further from those record levels thanks to pharmaceutical stocks.
Look, the market wants to go up. It's that simple sometimes. Sometimes the power of momentum is more powerful than the power of logic, than the power of valuation, than the power of economic reality, Main Street reality. And what I think we're all saying and we're observing is there is a major difference between what is going on in the real world and what is going on in the market. And that's absolutely fine. The market can do whatever it likes, but eventually there will come a time of reckoning. Now, whether it's over the shutdown, whether it's over the deficits, whether it's over extraordinary valuations for very average companies, whether it's extraordinary valuations for companies that haven't made money, won't ever make money, or the companies that are making a lot of money on the promise of greater ROI and ROIC and what have you to come. Quite frankly, a lot of that is never going to happen, and a lot of these companies will fail, but some of them will be successes. So, you know, it's an extraordinary time in market history, I would suggest, at the moment. So we need to move on because we are into day two of the shutdown. We
are indeed, and the question is how long this goes on for, as day two is now where we're at in terms of the first US government shutdown since 2018, and the impasse is set to last until at least Friday, with the Senate out of session today. A Republican stopgap measure to fund the government through to the 21st of November, and a Democrat proposal which would tie healthcare benefits with funding both fell short in the Senate yesterday. Both parties have traded barbs, blaming each other for the shutdown. The White House said layoffs of federal workers are imminent. Press Secretary Caroline Leavitt said President Donald Trump had directed his cabinet and the Office of Management and Budget to work with agencies to identify where cuts can be made. The Trump administration also froze $26 billion in funding for Democrat-leaning states, including New York and California. In a post on Truth Social, Trump urged Republicans to use the shutdown to clear out dead wood waste and fraud. The shutdown has also halted the release of key economic data. September's non-farm payrolls report will not be released on Friday amid a pause in almost all activity at the Labor Department with weekly jobless claims also impacted, which now leaves us down to the ADP numbers. And don't forget, there's been a disconnect sometimes between what the private sector data is telling us versus non-farm payrolls at a crucial time now for the Fed.
For sure, it's an imperfect data set for markets and the Fed to rely on, but it's all we've got right now. In terms of that market action, here's the rally for you to see. All three of the majors ending higher. The tech-heavy Nasdaq gaining about 0.4%. As Karen mentioned, though, the bulk of the buying, the real leader in the market was healthcare. We had extraordinary trade in a number of the healthcare stocks. The overall basket up 3% in the S&P 500. I have been reading through commentary this morning, analysts saying it has been the move of the week, this re-rating of the healthcare sector as we get some policy clarity from the Trump administration. Now that positive performance stateside has set the stage for a positive session in Asia overnight. We've got gains across the board and fairly sizable at that. You've got the South Korean market up almost 3%. You've got more than 1% worth of gains for the Nikkei 225, the Hang Seng over in Hong Kong, as well as the Australian market. So very strong trade overnight. We also had very strong trade in Europe yesterday. So in lockstep with the move higher in the U.S., the Stoxx 600 yesterday gained more than 1%. It was actually the best daily performance for the European market since May. It was the fourth positive session in a row. And at this point, it looks like the gains are going to continue. As for U.S. futures, here's the indication for Wall Street at this stage. We're looking at a pretty muted start, not a huge amount of action at this stage.
So private payrolls, as we have already mentioned, saw their biggest decline since March 2023 last month. Companies shed 32,000 jobs in September on a seasonally adjusted basis, according to ADP, well below expectations for growth of 45,000 jobs. ADP chief economist Neela Richardson gave CNBC her take on the labour market outlook and its effect on the broader US economy.
First of all, we've seen very low initial jobless claims, which means that this is still a low hire, or no hire in this case, but also a low fire jobs market. That's very important. The second important other data point that we have to weave in here is Q2 growth rates for the economy as a whole. So that GDP number was strong. It was robust in the second quarter.
Meanwhile, the Supreme Court has allowed Fed Governor Lisa Cook to remain in her role ahead of oral judgments in January on whether President Trump is able to fire her. Trump had asked courts to allow him to remove Cook while the lawsuit is pending. He's seeking to remove Cook over allegations. It's still allegations. Where's the charges? If it's that slam dunk. Allegations of mortgage fraud, arguing it constitutes cause under the laws governing the Fed. Cook denies wrongdoing and says the president is using the claims as a pretext to fire her for her policy stance. We're going to hear from the US Treasury Secretary Scott Bessent later today. Don't miss that conversation at 12:30 London time. Daniel Murray is Deputy CIO and Global Head of Research at EFG Asset Management and joins us now. Daniel, lovely to see you. You heard what we had to say about the markets at the top of the show. And quite frankly, I think there is a degree of ride it while it lasts from a lot of people out there as well. Enjoy the market rally. But actually, does it have longer legs and more longevity? Is it going to be backed up by economic data, or actually are we in dangerous territory?
So I think what's been surprising this year is that despite all the uncertainties about Trump, despite tariffs, despite all the geopolitical noise that's going on in the world, markets have done incredibly well this year, and also actually the economic backdrop has been remarkably benign. Yeah. So I think that's the setting, that there's been a lot of headline noise and a lot of headline news, but actually it hasn't really impacted markets. I think a part of what's happened this year is the fact that people entered the year very nervous. Obviously last year was another great year for markets. A lot of people entered the year more bearishly positioned. As the years progressed, they've realised it hasn't been as bad as expected. So I think a part of it, at least, has been a catch-up trade.
I'm sure it was just a year ago. I'm sure it was roughly a year ago that Goldman Sachs put out a piece about returns for the next 5 years or whatever it was, maybe 10 years, I think it was, that were going to be mid-single digit or lower, I think it was. I'll dig out the piece as well. Anyway, it wasn't going to be anywhere near the kind of spectacular gains we've seen in year one of that piece, of that timeline as well. Have the analysts, has the market been way too cautious, or actually is the market ignoring that caution and actually is going to find itself in trouble?
I think it always, sounds smart to be cautious, but I think on this occasion the market's been wrong-footed. But I think that's, the wrong-footedness of the market is part of the reason why the rally has been so strong this year. There's just been this necessity to cover those shorts. And as the market has gone up, so it's dragged in more players and forced individuals and institutional investors to cover their short positions, and I think that's what's been.
There you go. Can I just find that? I found the piece. It was October 2024, so yeah, virtually a year ago. Our model forecasts that the S&P will generate a 3% annualized nominal total through to 2034. Well, we had all that almost in 1 year. Anyway, that was the piece.
No.
As we head toward the next Fed decision, I can't help but wonder whether we're going to see a bit of travel and arrive, given the March higher that we've seen and the fact that a lot of the rally seems to be underpinned by this expectation that we're going to get Fed rate cuts and what that is going to serve, how that's going to serve as a tailwind for equities. How do you think about that? Is there a chance that we do have a bit of travel and arrive coming up?
Absolutely. I mean, rate expectations have been really volatile this year. We've shifted from the market expecting 5 rate cuts this year down to, I think, 1 at one stage, and we're now back up to another 2 into year end. So very volatile conditions. I think if you look at this objectively, what the Fed is trying to achieve is full employment and stable prices. Inflation is a little bit above the ideal rate, but it is relatively stable, and the labour market remains relatively tight, albeit with some fraying at the edges. On that basis, I think the market is quite fully priced for rate cuts, and I think that's at the top end of what's reasonable. I think you also have to ask yourself, why is the Fed cutting? If the Fed is cutting because inflation is coming down but the economy remains reasonably robust, that's a good environment for markets. If the Fed is cutting because it's trying to support the economy that looks like it's weakening dramatically, that's a very different set of circumstances.
And we are in the latter environment, right? I mean, the reason that the Fed is poised to cut is because they're more concerned about the outlook for the labor market than they are about the upside risk to inflation. What's your take on the latest data? We got the ADP report yesterday, as we just heard from Nella Richardson. It's basically a no hire, no fire environment, but ultimately something's got to give.
Yeah, look, I think you always have to triangulate across multiple data points. So you look at something like ADP, that was weak. Obviously, non-farm payrolls has been a bit weaker. But as Nola said, the initial jobless claims, which is actually a full data set, that's real data, that has been really robust. I think you put that together, it tells you that the labour market is probably a little bit softer at the edges, but it's not collapsing yet. Obviously, there's a risk that what starts out as a gentle run turns into a stampede, but that doesn't appear to be the case at the moment.
I want to talk about how to be tactical around the markets at this stage. I've heard a lot about the tailwinds of the BBB, the Big Beautiful Bill, and the effects of that stimulus into 2026. I know you're writing about it as well. How do you tactically play a trade like that when you've got records on the 3 major indices? Is it time to think under the surface some of the smaller, medium-sized companies that start to benefit from that type of regime?
Yeah, look, one of the impacts of tariffs and the One Big Beautiful Bill is that it's going to be more domestically focused in terms of US activity. So certainly we have a view that that's going to be supportive of the smaller and mid-cap companies. And obviously those companies have also lagged in terms of market performance quite a lot.
They've kept up a bit, but they are still laggards versus what you've seen on the major indices, right?
Yeah, exactly. And of course what that means is that you get a valuation gap that opens up. And so that's something that tends to be more supportive. The difficult thing, of course, is always timing. Yeah. And that's always a challenge.
Well, that's what I wanted to ask you. I mean, going into year end, we've seen moments like this before where the market has run extremely hard. It has a pullback phase before it then recaptures some higher territory in a Santa Claus style rally. How do you think the rest of this year plays out?
So fundamentally, I think our core opinion is that it's a decent year, that we get that classic sort of year-end rally. The macro data holds up. We get decent earnings. Everybody calms down about Trump and the government shutdown. But I think the risk here is that actually tariffs haven't been avoided. The impact has just been delayed, and that we start to see companies deferring the hiring decisions more, companies starting to lay off on big capex plans, and companies starting to just behave in a more cautious way. And that would happen at the same time, of course, as prices would be going up. So that's the risk. Not our core view, but that is a risk out there.
But I'm going to try and think of the counterfactual. If the market continues to rally and the economy stays where it is that divorced from reality or is that common sense? This is what I think all our viewers are really asking the question. They are riding this. I had a very defensive, I was allowed to have this trade on. There's certain things we can't do. We don't own individual stocks. I had a very defensive trade on. And it went on, and it went on, and it went on. So I just took a profit. And it was stupid. Because it's gone on, and it's gone on, and it's gone on.
I think we've all got a few of those stories.
Well, yeah, but it was. I used the same parameters for whether I should buy or sell or hold that I've done in my entire career. When I used to be a trader as well, I took decent double-digit profit on this trade, but I was stupid to take that trade off because it's just carried on going as well. So what I'm asking is should we just ignore the logic at the moment, or do we just carry on riding this tiger?
Well, I think it was Keynes who said the market can be
irrational. Longer than I can remain solvent.
Exactly.
Yes, exactly,
and I think that's always a good quote to bear in mind.
Yeah.
Look, I think you're always trying to balance, what do the fundamentals tell you, what's your sort of medium-term view, and then against that you have to look at things like positioning, and I think it's that positioning element that's really been out of kilter this year. And so I think, it looks like investors have caught up a bit, that we've moved from being net short to net long. So that suggests that we're probably towards the tail end of the rally, but I think there's probably more to go.
There are parts of Europe that have been left behind in this rally. I mean, the FTSE 100's gone for it finally. It's broken free from the reins that have trapped it for many years. But other major markets in Europe haven't been as aggressive in recent months. We've seen a real pivot back towards US equities. Is there a phase now into year end where international investors explore some of the European equity story again, whether it's the German stock market, French stocks as well have been left behind?
Yeah, of course, you naturally see this rotation in markets. Something outperforms, it then looks relatively expensive compared to other markets and other sectors. And so you naturally see that rotation. Of course, the big catalyst for Europe this time last year was excitement over the German fiscal package.
Yeah.
That then got fully priced and there was a period of disappointment. And I think we're now back in a position where there's going to be more positive news flow on the German fiscal package, and combined with that underperformance over recent months, I think that's a relative tailwind for Europe.
Daniel, thank you so much for joining us this morning. Great to have you for the conversation. Daniel Murray, Deputy CIO and Global Head of Research at EFG Asset Management. Coming up on the program, we're going to cross live to the Milk in Asia Summit in Singapore, where Monica will be joined exclusively by the CEO of Canadian aerospace firm Bombardier. Plus, we'll break down a slew of news from OpenAI as the firm inks a chip deal and launches a new app. And as European political community leaders prepare to meet in Copenhagen, we will be joined by former European Commission President Jose Manuel Barroso. That conversation at 8:15 London time. Welcome back to the show. The European Commission is set to propose slashing steel import quotas by roughly half and raising tariffs on excess volumes to 50%. That's according to the EU's industrial strategy chief, Stefan Sejourne, who briefed the industry ahead of an announcement expected on October 7th. Canada's Bombardier will post third quarter results on November 7th, with attention on how the business jet maker has managed tariff uncertainty in recent months. The group reported a higher than expected cash burn in its second quarter as it increased inventory amid an unclear outlook on duties. Now, Monica joins us from the Milk in Asia Summit in Singapore with the president and CEO of the company, Eric Martel. Monica, good morning.
Good morning. That's right. Tariffs, a big topic here today, as is AI and the global economy, but specifically with tariffs, I'm happy to be sitting here with a gentleman who's the head of a company that's both close to the tariff action, both where you sit in terms of being a Canadian company, as well as the global aviation industry. So Eric Martel, President and CEO of Bombardier, thank you so much for joining us today. I want to talk about this issue of tariffs. You've got a lot of customers in the United States. Canada and U.S. relations not exactly good right now, but you also have a lot of suppliers based in the United States right now. How has this changed your business?
Well, thanks for having me. We're headquartered in Canada, of course, as a company, but you said it. Our biggest market remains the United States. I think what's important to understand is there's been a free trade agreement in aerospace since 1979, even before the agreement that we know today. And you know what, Bombardier is an example. Not only we playing in the US, but we're creating a lot of jobs. We have 2,800 suppliers in the US. In some cases, if I compare to my competitor that are American, sometimes we have more US content on our plane than my counterpart in the US. So I think it's important to understand that. So I think at the end of the day, common sense will prevail. We do create a lot of jobs in the United States, either by our manufacturing footprint, our own manufacturing footprints, our suppliers, but also our service center that we have around the U.S.
But has this at least made you think twice about perhaps exploring more business in other regions like Europe or Asia Pacific?
No, clearly, but our business is global. So biggest market remain the U.S., but we're selling a lot of planes in Asia Pacific. Actually, it's been a growing demand in the last few years. Europe has always been solid. Middle East is very solid also. So we are a global player. We also have a defense division. We basically use our platform, modify them with some mission hours that could be American, could be European. And then we're making our airplane available for defense purposes, surveillance, communication nodes, different type of applications.
I want to talk about the new defense avenue, but before we do, I just want to ask you, you've also gone on record talking about how you had worried about maybe your company would become collateral damage between problems between Canada and the U.S. Do you still worry about that now at this point of the year?
I think I said that common sense will prevail. I think, as I said, we have a huge, we're creating thousands and thousands of jobs in the United States as a company. We're selling our product into the state, but globally also. And, I still believe today that, it's all going to go okay. There's a trade relationship that is significant between the two countries, the biggest one in the world actually between two countries. I think we both need each other. And I think aerospace, as I said, has been built over decades around a global supply chain.
So your company has undergone a major transformation. You jettisoned the commercial aviation and rail back some 5 years ago, now just purely business jets. We also, though, see a global shortage in jets. So I want to ask you, how do you feel now some years on about that decision?
I feel pretty good about that decision. You've seen our financial performance improving quite significantly over the last 5 years. And, there's been actually, it's interesting, COVID. Everybody were concerned about COVID in our industry at some point, but it's been an accelerator for private aviation. Today, there's much more jet flying around the world. Bombardier, we have 5,400 jets flying all around the globe. And COVID was an accelerator. COVID, a lot of people in COVID couldn't fly commercially with normal airline. They had the wealth and the ability not to buy maybe their own jet, but maybe to fly hours or buy a share of a jet. And we've seen the fleet operator. When I say fleet operator, think of NetJet, VistaJet, and FlexJet. These guys are huge customer of Bombardier. We have pretty much 20% of our delivery going to these guys. And these guys, I've seen a major surge in demand. Think if I look at the airplane that they're flying, the Bombardier plane, they're flying 59% more hours than they were in 2019. So it's been a major surge, a major shift adjustment after COVID. And we still see that capability and that demand around growing.
Where specifically do you see the most demand? Is it from companies like the VistaJets that have subscription models, or is it from high net worth individuals buying, or is it corporate jets? Where specifically is the growth?
The fleet operator were clearly the leader in their demand and asking, but also, the individual that are chairmen that have global business that needs to be moving around quickly, and one day they're in Singapore where we are right now, they need to be in New York and tomorrow, and in London 3 days after. This is a productivity tool. People think that it's only the rock star flying on our private jet. There's a few, but it's very minimal. The majority of the people are people that have common global business. They need to be able to move around quickly with their team. So we make these airplanes, basically a replica of how it would be at home, how it would be at the office. They have connectivity, the same connectivity that you will get at the office. If you're going to be flying 17, 18 hours, our Global 8000 will be the flagship of the industry. You can fly long run, and you can have a bedroom in the back so that you can come out, you can have a shower, fresh, ready to go to your meeting as soon as you land, basically.
And this plane, a Global 8000, is it still on track to be released and hit the market this year?
It's going to hit the market this year. So we're going through the final documentation of certification right now. It's basically an evolution of our Global 7500. But the airplane is going to be the fastest airplane in the world, will be the longest range in the world, and this is like a product that is basically a replica of what you would find at the office or at home, as I said earlier.
And you were hired as a transformation player. Is the transformation of Bombardier complete?
I think at the end of this year, we will be able to declare that the transformation we've announced 5 years ago has been completed. We pretty much, check all the mark of what we committed 5 years ago. All happened. Even a lot of things happened a year before. So now we're looking at the future to grow our services division. Our defense business is doing extremely well right now. So we're very optimistic about the future of our company.
Eric, thank you so much for your time.
Thank you so much.
This is Eric Martel, President and CEO of Bombardier. It's back to you in the studio.
Monica, thank you so much for bringing us that interview. Really interesting stuff out of the Milken Summit over in Singapore. Let's take a break now and have a look at European futures as we head over. We're looking at a green start to trade here in Europe. So building on yesterday's strong rally where the Stoxx 600 gained more than 1%. We'll be right back.